We all know that taxes suck and that nobody really likes to pay them. But as small business owners, we get hurt by them every single year as well. Then you pile on this dumpster fire of a year that 2021 has been, and we all need to save every penny we possibly can this tax year. Large multi-billion-dollar corporations have teams of CPAs looking for every angle to save them money. But what about us, the small business owners? We usually get shafted because we simply do not know the tricks that the big corporations use. Here is the #1 tax loophole for LLCs and S-Corps that everybody misses every year. All this and more in today's video. Hello and welcome to the Stephen Carlson Show. I'm Stephen Carlson. I'm a tech entrepreneur, real estate investor, author, YouTuber, paramedic, and Clyde is hanging out down here. I've also changed how I record my audio, so I hope this sounds a little bit better. Let me know what you guys think, comments down below. As we speak right now, we have 33 days till the 1st of next year. So of course, this means we only have 32 days to implement this loophole. But thankfully, you only need 14. Before we cover that, just a reminder, I'm not an accountant, nor am I a lawyer. So use this kind of as a starting point for your research and consult with a competent CPA before implementing any tax saving strategies. Or said another way, if you do something stupid, get it wrong, and get in trouble with the IRS, don't sue me and don't sue Clyde. In a previous video, I covered how smart business owners can take tax deductions from their home office, including a unique loophole that allows you to write off your home office as a second business location, even when you have a physical business or storefront. Check out that previous video by searching YouTube for Stephen Carlson Show, COVID Tax Savings Hack. 26 U.S. Code Section 280A, the disallowance of certain expenses in connection with the business use of a home, rental or vacation home, etc. This is a section of the U.S. tax code that allows you to take an additional tax benefit for your small business. Best of all, you can take this credit on top of also writing off your home office. Basically, this is a loophole that allows you to rent your house to your business for 14 days without having to report any of that income. The money that you collect is 100% tax-free, but you also get to write it off as a business expense on your business taxes. So how exactly does this work? Great question. Let's get started. Section 280A of the IRS code, which describes how to do tax accounting for mixed-use homes, says that if you personally use a home for at least 14 days a year and you rent the home for 14 days or less for the year, you can exclude all of that from your income taxes. Now, on the surface, this doesn't really sound like a very big loophole, but it is. Now, first, let's get a quick history as to why this tax strategy came to be. That way we can better understand it and figure out how to apply it to our situation. Carlton has a great video showing the history of this tax loophole.
Follow me back to the 1970s. Back in the 1970s, in the city of Augusta, Georgia, many residents would rent out their homes to those who would attend the annual Masters Golf Tournament. You see, this annual Masters Golf Tournament was becoming so well known in Augusta, Georgia, that people from all around the United States would funnel into the city of Augusta. Many residents in Augusta, Georgia would open up their homes to these travelers, allowing for them to reside during this tournament. Well, one of the things that we have to look at is all of the income that these homeowners were taking on. If you're renting out your home, that's taxable income. And many taxpayers who had this situation come up were being penalized for renting out their homes. The government came in to help out the residents of Augusta, Georgia by implementing IRC Section 280A, which allows homeowners to rent out their home for up to 14 days per year without needing to report the rental income on their individual tax returns. This allowed for everyday taxpayers to take advantage of being able to lease out their home to travelers who wanted to use their residence. And now the tax code allows for business owners to be able to take the same advantage.
As we learned, this tax code was designed if you own a home and you rent it out for less than 14 days. So continuing with the example, if you own a beautiful home near Augusta National Golf Course, that's where the Masters tournament is played, and you're willing to rent this house out during the tournament, then in this case, you could easily get $25,000 per week rental. And that's $50,000 of income over those 2 weeks, completely tax-free. Now, that's a great deal. And if your marginal tax rate is like in the 40 to 50%, like many people live in that area, that's $25,000 free of charge. Now, this is great and all, but if you don't own a house near the Augusta National Golf Course, where else could you use this strategy? This is where, as a business owner, you can also use this to your advantage. Now, you do need to be disciplined about how you set this up. So if you have a separate business, maybe you're doing independent contracting, gig work, you have an S-Corp, an LLC, partnership, whatever. Your business can pay you rent, and your business is able to deduct that as a rental expense for themselves. But you don't need to include that income on your personal return. Okay, well, how about we use an example to kind of put this all together? Maybe you own a condo out at the beach. If you use this condo personally for at least 14 days for the year, you can also rent this condo to your S corporation for 14 days out of the year. Obviously, you need to have a real and robust business purpose for the S corporation to rent your condo. You can't just do it just for fun. But a little cleverness can go a very long way. For example, maybe you could meet some clients or potential clients in that area and spend the week out there. Now, let me point out something that may be obvious, but it's essential. If you own a property within a resort area or where there's a special event, the peak nightly rates are going to be astronomical. Just like during the Masters tournament, where you could rent that house for $25,000 per week during the time of the tournament, during the rest of the year, maybe you could get $1,500, $2,000. It's that time frame, that specific time frame, that you're able to collect the most amount of money. Similarly, maybe you have a place in Palm Springs that's very nearby where Coachella or Stagecoach music festivals are held. During those weeks, you could easily get $10,000 to $15,000. So you could rent the place out and pocket the cash. Or you could rent the place back to your business during the same time frame and charge yourself the going market rate. Maybe you don't want somebody else in your house. Now you can just rent it to yourself. Now, this may seem like a dishonest loophole, but it's not. Businesses need place to have meetings. They need to have board meetings, tax meetings, shareholders meetings, strategic planning meetings. You get it. You need to have meetings. In most cases, a business would rent out a meeting room, a conference hall, or even a ballroom at a hotel room. This rental would include charges for the space, the state and local taxes, food, drink, Wi-Fi, and any other additional services. You probably have the same things in your house. You have chairs, you have tables, you have food, you have drinks, you have Wi-Fi. You have a Bonnie and a Clyde, maybe. Well, maybe you don't. I do. These are the same types of things that you would get from a place when you would normally rent it as a business. And this is where the IRS's 14-day rental rule comes in. As a business owner, you are able to claim a home rental fee as the business expense. After all, if you weren't renting the space from yourself, you would be renting it from someone else, wouldn't you? And as long as the number of days that you rent the property out is less than 15 days for the year, the income that your company pays you is completely tax-free on the personal side. Now, there is a small catch. Your home that you rent out needs to be a place where you can prepare food and have a toilet and able to qualify for Section 280A. So that means, depending on your situation, maybe a rental cabin out in the woods may not qualify if it lacks a toilet. But recreational vehicles and boats, as long as they have a kitchen and a bathroom, they would qualify. Additionally, the IRS only allows you to take this deduction on your primary residence that you are listed as the owner. So if your house is listed in your parents' name, your girlfriend, your boyfriend, your auntie, whatever, then it's not going to qualify. Your name must be listed on the deed. Now, of course, other family members could be listed on the deed as well. The key is your name must be listed. Using this creatively, you can pocket a couple extra $1,000s for the year and write it all off on taxes. I really hope this tip was something that helps you out. Just remember to check with your accountant before you implement it. And finally, don't forget to check out www.open4.business and register your business today. Thank you very much for watching, and I'll see you on the next one.